I'm Erin Hines with Elliott Wave TV. Today I'm chatting with Jeffrey Kennedy, producer of Traders Classroom, an educational subscription service that teaches you to spot trading opportunities for yourself. So Jeff, a great analogy that you use in your webinars or at speaking engagements is an analogy about different hats. You mentioned taking off your analyst hat and putting on your trader's hat. What's the biggest difference between being an analyst and being a trader?
Actually, that goes back to a live event I did a number of years ago that got a lot of people excited and talking. And what it actually was, it was a 2-day event. And the very first day, I had all the attendees put on a hat with the letter A on it. And that stood for analyst. And then the next day, we took that hat off and I gave everybody a baseball cap with the letter T on it. That meant trader. And the reason I was having everyone do the exercise is I wanted people to really understand the importance of looking at the market through the mindset of an analyst and also looking at the market through the mindset or through the eye of a trader. And simply put, it's where you wear different hats. Now, for example, an analyst, when I'm looking at the market analytically as the editor of, say, Commodity Junctures that I write, I'm looking at the market analytically. And what I mean by that is I'm looking at different price paths. I'm looking at making a forecast. I'm evaluating probabilities. I'm looking at chart evidence. I'm trying to support my case, whether it's bullish or bearish, by looking at indicators and oscillators, perhaps even Japanese candlestick analysis. That's the way I look at the market from an analytical point of view. Simply put, I'm looking at the market as a way of what could possibly happen and what is likely to happen. Now, when that step is behind me, I then have to look at the market from a trading perspective. How would a trader look at this market? Because a trader, many of the questions that an analyst has to face and answer, traders do not, and vice versa. For example, an analyst doesn't have to look at the market through the lens of possibly evaluating risk-reward on a buy-side or a sell-side position. But if I'm a trader, I have to answer those questions. For example, if I have a portfolio of say $10,000 or even $100,000. If I see an opportunity, say in Apple or Netflix or any market, possibly crude oil or gold, how much do I allot to that? These are questions that that a trader, and more importantly, professional traders, have to answer. So whenever you're doing what we do, not only as analysts and traders, it's very important to look at the market and understand the different hats that you actually wear.
The Elliott Wave principle is an excellent tool. How do you use it as an analyst and as a trader? Is it better for one situation over another?
Analytically, I would probably say that the wave principle is my foundation. I always begin looking at the market from an Elliott wave perspective, because the value of what the wave principle brings to me or offers me as an analyst is that it provides a context. I can look at a price chart, whether it's 3 months of data or 3 years of data or maybe even 3 decades worth of data. The wave principle is an excellent tool allowing me to understand where I am within the larger Elliott wave patterns which are operative in that market. I find that the wave principle is an excellent tool, not only an analytical tool, but also a trading tool, because I utilize the wave principle to identify high probability or high confidence trade setups.
Jeff, thanks for taking the time to chat today.
My pleasure, Erin, anytime.
If you're interested in learning more, please visit the link below. Thanks for tuning in to Elliott Wave TV.